Now starting. All attendees are in listen-only mode.
Hi, everyone, and thank you for joining our California Brokers Business Accelerator with our LA broker, Omar Helmand, Riverside Temecula broker, MaryJane Morris, and our San Diego broker, Tom Bullock. Before we begin, I want to say how happy we are to now offer a ton of great free marketing tools to all of our agents. These are now available in the AJI University. Our goal is always to give back to our agents by offering the newest tools and technology to you. None of this would be possible without you and your amazing amount of agent referrals to AJI. As Allison James continues to grow with agents referring other agents to our brokerage, we will be able to provide more of these tools to you. Remember, you can earn a monthly or yearly residual payment simply by having an agent join us. All you need to do is contact Jeff Jabora or Alicia Aratari in our National Growth and Development Department and provide them with the contact information of the agent who you would like to refer over. I would now like to introduce Shelley Hoyseth, Senior Loan Officer with our Preferred Lender Movement Mortgage. Good morning, Shelley.
Good morning. Good morning, everybody, and happy holidays. Merry Christmas, Hanukkah, Kwanzaa, and all that good stuff. So MJ is going to be talking a little bit later about closings at the end of the year, and so that did spark me to remind all of you that it is not too late to get some new contracts in and close them by the end of the year. I can definitely do that with our 20-day or less closings. We are definitely going to be getting people in before the end of the year if they need some write-offs or if they just want to be in by Christmas. So don't forget about that. And one thing that I've noticed that's come up from other lenders is, in fact, I just had a deal. It's now having to be extended. It was supposed to close 2 days ago. Actually, it was supposed to close a week and a half ago. But my borrower is relying on their buyer's lender, and their buyer's lender would not issue the CD, the closing disclosure, without having final loan approval. So that was really frustrating on our end because with the holidays and everything, it basically caused a week and a half extension. And if you're hearing lenders say we can't issue the CD till we have final approval, you might want to have a serious consideration of changing lenders because that is not a TRID requirement and that is not how it has to be. We issue the CDs as soon as we have fees and everything updated, insurance, everything in, and you don't have to wait till 3 days before closing to issue the CD. So I just want to throw that out there. That's something that's been coming up. I'm going to kind of go in a little deeper than I normally do today. The brokers, we talking about financing in the contract. So if you happen to be near your computer and you can pull out one of your contracts or you have one, you can just kind of follow along. I'm going to talk about some tips and how to fill out the financing portion and some things to watch for when you are completing a contract for a buyer to make sure you're not messing up their loan or causing a potential problem down the road. So first of all, in the financing terms, that initial deposit, as you know, is their earnest money deposit. And then if they have an increased deposit, that's where you would put down, you know, if they were going to be just doing an additional deposit. Sometimes you don't really necessarily need to worry about that because that would only apply if you knew for a fact they were putting additional down payment for like upgrades or something like that. On the first loan section, a lot of people ask me what to put in here, if it's FHA or VA because of the funding fees. You can just use the base loan amount there. You don't need to calculate in the funding fees and the mortgage insurance if it's an FHA and VA borrower. So don't overthink it or let it, you know, mess you up. Just calculate if it's 20% down, just it's a $500,000 purchase minus 20%, that's going to be, you know, $400,000 base loan, and then in the balance of the down payment, you're going to put the difference between the earnest money deposit and the rest of the down payment to get the final purchase price. I think most of you understand how to do that portion. And then one thing I want to mention is you always want to get the FHA VA mandatory clause signed with the offer. So start early on that. Don't neglect to get that done, and don't wait on that because that can hold up your appraisal. There's a section here you see second loan, And a lot of people probably just ignore it because people think there's no such thing as an 80-10-10 anymore, but that is not true. We do offer first and second loan combinations, which are great in counties like Riverside that have lower loan limits. You can avoid jumbo by doing a first and a second, up to 90% up to a $750 total loan amount. So it's a really great program. So don't hesitate to ask me about that if you have a client that you think might benefit from that. It also helps people who maybe they didn't want to put a full 20% down because they didn't want to dip into their assets, but they don't want to pay mortgage insurance. So sometimes they'll just break it up with a 90-10-10 just because they want to. It's a pretty great option, so keep that one in mind. I've hardly ever in the first loan section where it talks about the rate, I don't always see that filled in. I know MJ and some of the brokers, they want to see that filled in. So you're going to want to, if you want to ask me, gee, what's the going rate? But if you're on the list side, you're going to want to make sure that's not a super low number because you don't want them backing out saying, gee, I couldn't get this low rate, so now I'm not going to move forward. So usually I think rule of thumb is to put in there about a quarter or half a point higher than the going rate. And right now, in case you haven't been watching the news or you've been under a rock, rates are, have fours in front of them now. Pretty much 4 1/4 is kind of a going average. Of course, it depends on the loan program, but in case you haven't heard, there's not a whole lot of programs with 3s anymore. VA, FHA, you could probably still do that, but as far as conventional loans, interest rates have gone up quite a bit. So that's where we are on that. Let's see, additional financing terms, that's where you're going to want to put in the credits, if there's going to be seller paid closing costs, etc. I also recommend that you usually put it in the addendum and clarify that if you're going back and forth between the purchase price, like say one says purchase price is $400,000 with $5,000 in closing costs, and then they decide, well, we want you to pay $405 with the $5,000 closing costs. Don't just change the $405 on the addendum. Make sure you clarify the closing costs as well, because it does confuse appraisers and underwriters because they haven't been privy to all of your conversations back and forth. And sometimes when the final counter, it doesn't talk about the other items that were on some of the other counters, it makes it a little ambiguous as to what's really happening there. So on your final counter, try as best you can to button up all the terms pretty specifically. It's $400,000, closing costs are only $3,000, or whatever you need to do, just to make sure you don't want the appraiser messing up on what the purchase price is and having things come in low. So that's that section. Verification of down payment, that's your proof of funds. Usually I don't recommend shuffling around proof of funds. Make sure that you are blacking out the client's, account numbers and that kind of thing. Just maybe send a summary. Might be a good idea to ask the lender, because the lender has the borrower's authorization from the client and can probably provide that and, black out anything that's private. So you can provide proof of funds without putting their privacy at risk. Let's see. Talking about the loan terms and the loan contingencies. On appraisal contingencies, sometimes people want to shorten the appraisal contingencies to try and be competitive, and that is fine. On a VA, just be aware that the VA appraisers have 10 business days to get that in. So, that's basically 2 weeks of the transaction. So you want to be able to order the appraisal early, which goes back to having that FHA, VA, a mandatory clause in and signed. And you want to get it ordered as soon as possible, which we typically do within 24, 48 hours of the contract, because we're able to do all the electronic disclosures, all the disclosures up front electronically. That really helps us so that we can get that appraisal ordered right away. So loan contingencies, I know their standard is 17 days. because we fully underwrite up front at the pre-approval stage, we can shorten that down to 10 days if you want. It just depends on your comfort level. Some people, you know, agents always ask me, when can I remove my contingencies? So if you're comfortable with a conditional approval that says you're approved and the conditions look, you know, pretty clean, no big deal, then make a shorter loan contingency period. If you want final loan approval, loan docs and all that, well then obviously, you know, that's going to come closer to the between the 17 and the 20-day mark. So just kind of keep that in mind and know your client and their comfort level. If they don't take any chances, any risk, what have you, then you're going to want to make sure that you keep the contingencies in the 17 to 21 days standard timeline. And just remember that the lender is not a party to the contract. You know, we have not gone into these negotiations with you and determined these. So if you're not in communication with your lender or your buyer's lender as you're writing this offer, just be aware when you hurry up and you get in contract on a Friday or a Thursday or like the Wednesday before Thanksgiving, and you're doing a 20-day closing, be aware that that lender's not really getting it until 4 or 5 days later. So if they're quick and on top of it, then it's probably not going to be a problem. But if you're not sure, then watch those days of when your date of acceptance goes in so that you're not taking away 3 or 4 days of the business days for the loan. There are lender limits on seller credits. For the most part, just think in terms of 3%. It actually varies, but 3% is the minimum. Hardly anybody ever in California gets 3% of closing costs anyway, and typically closing costs are never, they're usually right around 2.5%. So with us anyway. I'll also take this time to remind you that on VA loans, Movement Mortgage does not charge any fees for our VA borrowers. So there's no lender fees, no processing, no underwriting, no points, unless they just choose to structure it that way. So that helps you to not have to worry about non-allowables. And if you don't know what I mean when I say non-allowables, then email me separately or give me a call and we'll talk about that. With Movement Mortgage, there typically is no non-allowables because we do not charge lender fees. That keeps the amount that the VA borrower can pay, which is 1% in lender fees and escrow combined. So therefore, the seller does not have to pay closing costs if you're concerned about that with a VA buyer. I'm going through some of this pretty quick because I've kind of jumped in at the last minute here on this stuff. So if I confused you or thrown anything out really quickly, just never hesitate to call, text, or email me, and I'll go over a little more specifically with you. Let's talk about other terms, and I know that Jeff's going to be talking about listing deadlines. So one thing to think about when you are, if you're doing a possession with +3, or if you've got a rent back situation, be aware that you cannot do a rent back for more than 60 days if your buyer is purchasing as their primary residence. So if somebody says they need 90 days, don't do it. You've got to do a 59-day or 60-day maximum because your client has to be into their home within 60 days or it cannot be considered a primary residence, okay? Let's see, what else? That's about it. The only other thing I wanted to touch on is the amendatory clause one more time for the VA FHA. If the appraisal comes in low, a veteran or an FHA buyer, they can choose to move forward with the purchase price even if the value comes in low. In other words, they can pay the difference if they choose to. So the contract supersedes the amendatory clause, meaning if they say in the contract they're going to waive their appraisal contingency, well, that's fine. It still has to appraise. You still have to get the appraisal. But if they say they're going to pay the $20,000 difference, they can do that. They'll just need to write a letter as to why they are willing to do that and why they think it's a good value. So don't let that mandatory clause scare you out of taking offers from good FHA and VA borrowers. Remember, those borrowers are in programs that are very stretchy. So that means, you know, if they sneeze or they do run out and do the dreaded buy a car or something dumb, it can absorb their debt ratios a lot better in those programs. So don't be afraid to take offers from people that are, you know, not your 20% down traditional conventional borrower. That's about it for me, unless the brokers, do you have any questions or anything for me, guys, that, or comments on something that I mentioned that you might want to chime in on?
Hey Shelley, this is Omar. I have a question for you, and some people also may have this question as well. And if you're getting a credit, as well as obviously you have to write the addendum, but let's just state that we're writing an offer and we write in a Section 1 clearance. Is that advisable, or is that something that you guys would rather not see or have it on an addendum outside of the purchase contract?
Well, termite is only a requirement on VA. So having termite clearance is a requirement in VA, so it doesn't really matter. You can put it in there, you know, because it's going to have to be done one way or the other. And I'll also state, however, it is a negotiable item. Who pays for that clearance? Okay, so the buyer and the seller, if the buyer wants to and has the means to pay for termite clearance on a VA, they can. The seller just has to pay for the termite report. Okay, all other loan programs, including FHA, conventional, we will only require termite if it's in the contract. So if your client says, I am not moving in there unless this thing has been tented, then go ahead and put it in the contract, and it'll just have to get done before closing. But if it's something that you guys can work out with credits or, you know, some other way, then I usually prefer, if you're not already at your maximum, you're not already using up every little credit from the seller, I usually prefer for anything, request for repairs, termite, whatever it is, that you leave it out of the contract and just whatever you guys have agreed to, if it's $3,000 to $4,000 worth of repairs, then just put in a $3,000 to $4,000, you know, seller credit towards the buyer's closing costs. That just keeps it a lot cleaner, because, you know, I've seen contracts come across that say, you know, $2,000 for the roof. Well, as a lender, we don't want to see that there's something wrong with the roof, right? Because now all of a sudden, well, what's wrong with the roof? And now we have to have a roof cert. And now you could have just opened up a huge can of worms. So keep the repairs addendums, you know, to yourself and work it out through credits is my recommendation.
Great idea. Okay, thank you so much, Shelley. Really appreciate you filling in and adding a lot of your insight on this. It's important. Obviously, you can't purchase a home without a loan, and you're giving us tons of insight, unless you're paying cash, but that's a whole different story. But you're doing a really good job of helping us out and understanding and getting our agents to be more compliant with what our lenders require. If you guys have any questions, feel free to reach out to Shelley. She's excellent. I know we can definitely use her help. One
other thing I wanted to mention before I move on with that is items of value in the home. If furniture or a dining room set or whatever is being included, that's another thing that, in other words, we can't lend on furniture. So you need, if you do want something included in, you need to put in the contract that they are conveying with no value. Or, you know, if they're buying something, they need to work out something between them if somebody's paying money for furniture. Because if it's conveying and it has some value, the underwriter's going to say, hey, if there's any value on that, we can't include it. So that was just something I want to throw in there too with credits.
Absolutely, absolutely.
All right.
Thank you so much, Shelley. Really appreciate your insight on this. And if you have any questions directly to Shelley, feel free to reach out to her. Her contact information is listed there. Our next topic will be twofold. One, speaking about the listing agreement and your listing period, and making sure that you register your clients so you're entitled to a commission. We've had this come up in one of our scenarios here with one of our agents, and they were not entitled to a commission just because of the fact that they did not register that buyer during the listing period, and the listing period expired, and that potential buyer that they had talked to through that listing period was planning on putting an offer in on the home after the listing contract expired. And that's something that's very, very important to everybody, I'm sure, who is listing a property. But before we get into that, I want to make sure we talk to everybody about business growth. We don't have a guest speaker today, so I'll be filling in a little bit of detail about how you can help grow your business in 2017. I'm sure everybody has the same plan in having a better 2017 than they did in 2016. Well, how do you do that? Tom, our state broker, our San Diego broker, has gone over planning for 2017 now, and we're a month out of 2017. How do we get prepared for 2017 here in 2016? One of the ways you do that is, number one, you create a business plan. And when I mean a business plan, you don't just say, I want to do X amount of deals and make X amount of money. That only is a basic business plan. When I say business plan, and I'm sure all of our brokers would agree, is you have to get as detailed as possible in your business plan. Beyond that, when you write out your number of deals that you want to do in that given year, let's just say you want to do 20 deals next year, and you want to make X amount of dollars out of those 20 deals, whatever your price point is, you have to break it down into how many prospects are going to get you to that 20 deals. How many prospects do you have to speak to on a daily basis to get you to 20 deals in 1 year? Now you have to break those 20 deals down into a monthly basis, a weekly basis, and then a daily basis. How many appointments do you have to go on? How many contacts do you have to have? And how many transactions do you have to have in general? Some fall through and some go through. You have to break it down into as detailed a number as possible. Then you have to source those prospects. What type of prospects are you going to go after? Are they going to be past clients? Are they going to be for sale by owners, expireds? Or are you planning on just going back into repeat and referral business only? You have to detail out every single source of your prospects, because every day we must prospect in order to get new business. If we're not getting new business, then we're going to stay stagnant, and obviously our goals are going to be too far-fetched for us to reach. Another really, really important aspect is scheduling. So scheduling is probably the most important thing beyond your business plan. Scheduling, I think, is the most important thing in our business. Given the fact that we are self-employed, we don't have somebody watching over us every day. That's part of why a lot of us got into real estate, is we don't have that boss hanging over our head, and you have strict hours. But you have to be self-disciplined in the fact that you have to have and create your own schedule and stick to it. Whether you want to work 3 days a week or 5 days a week or 7 days a week, it's up to you. But at the same time, you must follow a schedule and really make sure that you are detailing out your schedule from the morning until the hour that you stop working. My suggestion is 8 to 5 or 8 to 6. Your morning routine is extremely important. That's when a lot of people are prospecting, and a lot of agents will make sure that they have all of their prospecting done between 8 and 10 a.m. generally. If you can schedule your prospecting at that time, that's what I would suggest having your prospect time. You also want to prospect in the evening if you don't have any appointments. So if you don't have any appointments at 5 p.m. and you're getting ready to go home, or you don't have an office and you're at home, the next thing to do is continue to prospect and get more business and find more prospects to go possibly get an appointment with. But your schedule is extremely important in the fact that it gives you a definitive idea of what to expect for that day and every day for that week, that month, that year. So it falls in line with your overall goals for the year. And I'll be happy to detail some of this out. I have a really good chart that kind of breaks it down for you in terms of how many prospects do you need to get to a certain number of goals and deals, and how many deals do you need to make a certain amount of money. It really just comes down to your business plan and your schedule for 2017, and we can go over that with you. So if there's somebody out there that really just wants to make sure they have the best year of 2017, which I'm sure we all do, please feel free to reach out to myself, to MaryJane, to Tom. We'd be happy to go over that with you. So the most important thing about all of this is just make sure you actually have a plan and then follow through with it. Okay, moving on to our listing agreement and making sure you have a protection clause for your buyers that come in, or prospective buyers that come in during the listing period. Now, you already have a protection clause from the listing date until the expiration date. That you're automatically protected in that time frame when somebody comes in and they make an offer, or you're able to help present an offer to the seller during that time frame. But what happens if the prospective buyer comes into the listing period, and then the listing period expires, but then that buyer comes back and they decide to write an offer? Well, we have certain protections against that. Number one, there are a few forms. It's form RLAN, RLA, or RLAA. These are protection forms in the car win forms. They're basically forms that you can register buyers on during the listing period and let the seller know that you have this prospective buyer who came in, you showed them the property, you ensured that they were registered with you, and during that period, if that prospective buyer is someone who's going to write an offer after the listing period, you are still entitled to commission. Now, there are certain ways to go about this. So if you decide that you do want to keep that prospective seller and the listing period expires, but they've just decided to take the property off the market and they don't want to sell at that time, I'm not sure I would want to go back and negotiate with that person and lose the client if they decide to relist again later. This is for a prospective seller who is actually going to sell, and somebody who you want to earn a commission from and help them get to the end goal of selling their property. It also protects you in the case that the listing does expire and they list with another broker. As long as you have this form, these forms, RLA, which is the listing agreement, RLAA or RLAN, any one of these forms will allow you to register the clients. You can specifically write in their name, the date that they came in, and the interest that they had at the time that they did come in and see the property with your help, and then you can go back and verify that you have an earned commission. One of our agents had that happen. They didn't get the commission on this specific deal, but they were able to get other transactions out of it from this particular seller. They didn't want to ruin the relationship, so they just let that one go. They could have fought it, and I would suggest not really fighting it in those particular situations, but most importantly, it's important that you write in every prospective buyer's name. And I know we don't have a habit of doing this, whether it's an open house, whether it's a showing, register all of the buyers that come in through a form that's on WinForms, or if you want to just write it down on a sheet, if you have an open house sheet, register every client. That way, if the listing period expires and you do have this list, you are still entitled to commission for that buyer. I can't stress that enough, and it's important that we have this information relayed to our sellers as well, so they're aware of the fact that they still are entitled to paying a commission to the broker, whether or not it happened during the listing period. You also want to be upfront about this at the listing contract, at the time of listing, and your listing presentation. These are important facts to go over. I'm not sure everybody's doing that, but it's important to address this at that time.
Omar?
Again, yes.
Oh, I'm sorry. It's MaryJane from Riverside County.
Yeah.
I wanted to mention on that point that I actually made up a little rhyme for my newer agents, which is you have to name them to claim them. So I just wanted to throw that in, that you have to deliver that list to the client at the end of the listing, or you will not have named them and you can't claim them.
That's great. That's really good. That's a really good point. And you brought up a really good point. You do have to deliver the list before the listing period expires. You can't bring in the list after the fact and state that, oh, I had this list, but I never presented it to you. You have to bring the list in prior to the expiration of the listing. That's an important point, MaryJane. Thank you.
Of course. I also wanted to mention that a lot of people print out their lockbox list because they didn't keep a good list, and so they will print out everybody who used the lockbox and sometimes deliver that list. And while that's a good start for sure, I wanted to mention that you are never going to have a conversation about this subject without some annoyance on somebody's part. The buyer, it is going to be a tough conversation, and you need to be sure, because it's not going to be, people don't just pay without proof. So I wanted to be very clear that it's going to be a tough conversation, but if you do a good job, you've earned it and it's yours.
Well, just like anything else, whether you're asking for a referral or you're asking for a commission on an earned commission with a list of people, you have to make sure you're stating these things numerous times. That way, when the issue does come up, you have reference. For instance, I would always suggest either asking for a referral at the listing period, and again, I would suggest bringing this item up at the listing presentation. So you know that you're both clear, the seller understands, you are relaying the information properly, and then again, through the listing period, I have registered X amount of clients, here is the list if you'd like to see it, and then again at the expiration time. And if the property doesn't sell, you have a list that's protected, that another person can't just bring in that buyer and state that they were the first to show them. You have a list, it's verified, the seller verified it, you verified it, and I agree with you, it's very important to let all of our agents know, not just our newer ones, because I think sometimes we all forget, and so this is a good reminder and a good refresher. Unfortunately, it happened to one of our agents, they lost out on a very large commission, but you know, going forward, we know we can correct that issue. So MaryJane, I think you're up next, so hand it off over to you.
Thank you. Good morning. What a good class. A couple of thoughts I had on the earlier information. Shelley and Movement Mortgage are just awesome. I'm on my third family loan with them. I swore in my long career that I would never back another lender, but they are awesome. Truly, truly, the way that they do things, it's just amazing. The 6-hour underwriting is, anyway, I just can't say enough about Movement Mortgage. You should definitely be adding them to your playbook if you're not already. One of the other thoughts I had this morning when we were talking about making your business planning, sometimes I think one of the most important parts is a budget. You need to know when you're going to buy signs and when you're going to buy postcards and when you're going to do this, that, and the other, and what it's going to cost you each month. Together with your schedule, that winds up going back and forth in a push-pull kind of thing that leads, you know, the budget leads you to better time management, and the time management leads you to better budgeting. So I definitely wanted to throw in that budgeting what you're going to spend on your business is a key component to the your plan for the next year. I also am going to have out by the end of the year an entire first quarter training session, training schedule for the entire first quarter. I'm bringing in the board, I'm bringing in everybody, so it's going to be an exciting first quarter, and we definitely want to see you be wealthy this year. My topic for today, very briefly, is end-of-year closings. Many of you may or may not know that part of my career I was an escrow officer for 15 years, and at the beginning of every December we actually sorted out and made very clear with each agent in every deal whether that transaction could roll past the 31st of December or absolutely positively could not. And a couple of reasons for that are one that will put the most pressure on you is that there's tax reasons. If they don't close by the end of the year, they can't claim it. Absolutely positively has to be closed by the end of the year. You need to be very clear which of your transactions needs to be closed for tax reasons by the end of the year. The second one is as important and really cuts to the human heart, if you will. Every year I have one deal at least where the moving trucks are already rolling. The people are using the time to move. It's Christmas Eve. Everybody's closing early. The deal did not close. They don't have a place to go. They've got pets. If we all had an open checkbook where we could put them in a hotel and put those pets in a, you know, AAA rated kennel and all that, these things would be very much easier. but we do not have those solutions, and there is no magic wand. So when you call me and tell me that they're moving and the trucks are already rolling, or the seller can't leave the property because he didn't have his proceeds to close, I have no choice but to walk you step by step through the problems, which is, can they stay at their parents' house? Are we going to have the additional expense of storage? Are there pets to be concerned of? So I want to be very clear that every December I will be reminding you guys to know which transactions need to close before the 31st of the month. If they can roll into the beginning of the year, we can, as you know, every real estate deal gets reprioritized almost hourly, meaning sometimes you just got to put that deal ahead of the other one. This helps escrow and you and your clients make good decisions about whether they really want that moving truck or not. A general subject that this falls under is managing expectations. Across the board, just like Omar was saying about letting them know what's going to happen after the listing concludes, what Shelley was saying about, you know, the interest rate may not be what it is. If you are ahead of these topics, you're already 90% in the success ratio as far as they may want to talk about it again. They may wish to make some other arrangements that you can or cannot arrange for them, but across the board, managing expectations is the most important thing you can do. So I would like to encourage you to manage the expectations for December very carefully, because putting people on the street on Christmas Eve is heartbreaking. So I want to make sure you guys knew about that. And that's it for me, Omar.
Hello. I believe I'm next on the board on the agenda here. This is Tom Bullock. I'm the broker for San Diego. And just to go kind of along with the theme here, Shelley mentioned it earlier. Omar mentioned it as well as MaryJane. I've noticed lately that I've had a rash of our agents who are in the process of negotiating the seller to remain in the property after the close of escrow. That concept reminds me of an old adage. The old adage is nothing good happens after midnight. Well, I'd like to adapt it to real estate and state that nothing good happens after the close of escrow. So in managing your seller, when you take a listing agreement, I believe it's vitally important that you present to your seller the concept of getting ready and getting moved out. If they say, well, we need more time, we want to stay in after the close of escrow, for whatever their reasons, tell them a story. Tell them some of the disadvantages, not only to the buyer, but also to them, the seller. We had one situation, actually I've had the same situation twice recently, where our seller remained in the property after the close of escrow. There was a rental agreement that was completed. That was good. There was a deposit, security deposit left. That was good. And there was a rental amount that was negotiated and agreed upon. And that's good. But then what ended up happening was the seller moved out on the scheduled date. That's good. The problem was when the seller went to collect their deposit, the buyer then went in. The buyer was not happy with the condition of the property, number one. And number two, they decided that there were some items that were on that they needed to fix through the purchase of the property, but didn't negotiate anything during the actual purpose. So they felt it was within their right to go ahead and keep the rental deposit based on the fact that these other items that should have been discussed during the purchase didn't get handled. So that's a case where both the buyer and seller now are going to end up in small claims court fighting over this rental deposit. So again, my warning on this is please do not just lightly say, yeah, we can just get an extension and the buyer and the seller will be fine. Shelley mentioned that you can't do it more than 60 days. When I was in production and was moving my sellers and closing escrows, I always advised them if you're going to need a lapse of time, go to a hotel, go to a motel, figure it out during the course of escrow so it's not an issue. When that escrow closes, move out on schedule, and that way everybody's happy and there's no recourse after that. So that's what I have for today. I want to thank Shelley and Omar and MaryJane for their contribution today. I thought it was an excellent meeting. And I'll turn it back over to you, Sheena.
Thank you, Tom, and thank you everyone so much for joining us. We'd like to give a huge thank you to our California brokers once again for another great broker business accelerator, and Shelley Hoyseth from Movement Mortgage, and also to everyone who joined us today. And we hope to see you all next month. Bye everyone and have a great day.